Hello, I'm George Vessey, lead FX and macro strategist here at Convera, and today I'll be giving you an overview of our latest global FX outlook report for July. In this monthly report, we feature the key themes and events which are shaping trends across global financial markets. We provide extended research on FX volatility analysis, highlighting where exchange rates are currently positioned relative to their long-term averages. And combining all of this fundamental and technical research together, we generate FX forecasts, taking a scenario-based approach, which we believe is more suitable to safely navigate what can be a highly unpredictable market. So let's take a look at some of our key insights. Now, June was dominated by monetary policy, with the euro, Swiss franc, and Canadian dollar weaker as their respective central banks cut interest rates. A dovish Bank of England meeting saw the odds of an August rate cut double, and that briefly weighed on the pound. On the other hand, the US Federal Reserve reduced expectations for cuts in the US, the so-called dot plot now only signaling one US rate cut in 2024, and that caused the US dollar to climb to near 8-month highs last month. But the economic data coming out of the US recently hasn't supported this notion, and were it not for the events in Europe, FX markets would have been focusing on the welcome disinflation story in the US and the cooling of its economy and jobs market, increasing the prospects of more Fed rate cuts. It's this story which has helped keep risk appetite alive, especially in equity markets, where among the world's 20 largest stock markets, 14 have soared to records recently. Lower yields and the disinflation story have supported the US equity rally. And this narrative of US disinflation continues to gain credibility among market participants as consumer, import, and producer price indices for the month of May surprised to the downside. However, the uptick in other parts of the world, namely Australia, that's complicated the inflation picture going into the second half of the year. This has even seen the odds of a rate hike by the Reserve Bank of Australia increase, sending the Aussie dollar to over 2-month highs. The main question remains if inflation will settle below or above that 2% level central banks are targeting. But we've also had the snap elections in the UK and France, which have kept risk appetite in check. And it was the latter event in particular that added some unexpected volatility into financial markets, especially French assets. We saw the yield spread between French and German bonds surge to a 12-year high. And that resulted in the euro falling to multi-month lows against numerous currency peers. And the way ahead for France remains opaque, with outcomes ranging from a minority left government to a grand coalition of moderate parties, or even a technocratic government. In the short term, the election of the President of the National Assembly on 18th of July is going to provide a first glimpse of a new political equilibrium, and we think the euro is going to remain on edge up until that. In the UK, though, the election was a non-event for markets, as we expected, the Labour Party returning to government with the largest majority in 25 years. However, the promised continuity in the UK's fiscal rules and the prospects of closer trade relations between the UK and the EU have actually brightened the outlook for the pound. In fact, sterling was the strongest G10 performer in the first half of this year, and hedge fund bets for a stronger pound surged to their highest in more than 6 years just before that UK election. And that signals that investors were confident that a Labour victory would bring stability to the country's politics and economy. So with bullish short-term cyclical and political dynamics holding for now, the case for further upside in the pound remains compelling. But we do question whether there is enough to push sterling dollar into the higher range, with 130 as a new floor going up to 135 this year. There's a lot of data, central bank meetings, and of course the US election to continue. So now we have two opposing forces in motion, those being a fiscal versus monetary policy. And fiscal policy related to politics and the developments of the French election and the US election looming, and then monetary policy, being how central banks are reacting to the incoming economic data. Both have been affecting markets, contributing to some volatile directional trading recently, but we've witnessed US dollar drift lower amidst a string of weaker US economic data and falling yields, with 2 Fed rate cuts this year now being priced in by markets, and that's therefore one of the key themes in focus. However, the dollar's fall has been contained, and that's because of the political backdrop. Domestically speaking, from the US, the probability of a Donald Trump presidency has increased, and this has seen the dollar running a positive trend in the short term. And the reason for this is because markets perceive such an outcome as inflationary due to Trump's plans on tax cuts, tight immigration, and higher tariffs on imports. If this leads to the Fed keeping interest rates higher for longer, the dollar might remain stronger for longer as well. So to find out more about all of these topics and more further details on currencies and forecast scenarios, please check out our global FX outlook and visit Convera's blog page for access to all of our macro and market research.